The market is flashing the same warning from three different angles. So let me walk you through what each chart is telling us and why it matters for how you position your portfolio right now. This chart is the margin debt acceleration indicator. Margin debt is money investors borrow against their own portfolios to buy more stock. The red line shows how fast that borrowing grows year over year, and the black line is the S&P 500. When greed takes over, borrowing spikes. When fear hits, it drops. This chart confirms the same warning as the previous, and it has flagged three of the biggest market peaks in 30 years. Two caveats, though. The strongest signal comes when the red line hits an extreme and turns back down, not just when it's high. And it's only one piece of the puzzle, but the other pieces agree. Valuations are stretched currently, especially among the large cap stocks. Analysts are euphoric, and investors hold more stock than ever. I like this chart because it's simple. It shows the borrowed fuel behind a rally and asks the honest question before trouble arrives, not after. Oil has had a big short-term grip on the economy because of the Iran war. So set inflation aside for just a second and let's look at this chart. This is the S&P 500 from 1970 until today, and every red dot marks the exact month that crude oil finally peaked during a major price surge. Here's the pattern. Going back to at least 1970, the real damage to stocks does not start while oil is climbing. It starts once oil tops out and rolls over. You can see it in 2000, 2008, and others, where the market stalled or fell soon after oil hits its high. The reason is very simple. Rising oil price quietly drains money from households. It's a tax, and businesses. By the time oil peaks, that strain has already built up under the surface. We have seen consumer debt rise 11% year over year. So the latest red dot is one worth watching. If oil has just peaked, history says that the warning light is on. Pair that with stretched valuations and record investor optimism, and the signs of a real pending correction are ripening. Why I appreciate this chart? It doesn't guess. It marks what exactly happened at every oil peak for 50 years and lets the track record speak. Oil prices have a fast, direct grip on the economy. So the chart on the top, the red and green lines are crude oil and gasoline futures. And you can see the same story in both. After running up hard, they've rolled over and are falling sharply as we head down the right side of the chart here. Gasoline prices are correlated to oil prices, and so the concern was, how quickly will this drop? My belief is as the conflict cools and the oil price coming down, it's under 70 a barrel as I speak, it drags the inflation number lower with it. Cheaper crude means cheaper fuel around the world, and that is disinflationary, meaning it pulls price pressure down. The open question, as I mentioned, is timing. How long until that drop at the pump actually shows up in the official data? And that's the whole deal. The chart on the bottom, the blue line tracks central banks worldwide. Hikes minus cuts. Markets came in 2026 expecting rate cuts before the war, but the talk has flipped towards tightening instead. The reason is that inflation is stuck above target and the job market has held up far better than expected. Here's the tension. If oil and inflation are cooling, new Fed Chair Kevin Warsh would be fighting the tape by hiking into a slowdown. And his boss, President Trump, wants lower rates, not higher ones. So Warsh is caught between cooling oil on one side and stubborn inflation in the short term and a strong labor market on the other. I like these charts because it shows the cause coming down. The other shows the policy still leaning the wrong way, and the gap between them is where the risk lives. Thank you. And if you have any questions, please reach out.